Good morning, good afternoon, good evening. Welcome to this second OECD tax talks. And very happy to be back. We hope that today we will not have technical problems. Apologies for the last webcast. I fear we were victims of our success, too many people trying to join at the same time. But hopefully today you will all be able to listen to the webcast on the latest news on the tax matters. You have the Twitter account, our email address. If you want to send questions, feel free. We'll be able to respond to them later on. Today, you will have an update on the BEPS project. Unfortunately, we cannot do any webcast without talking about BEPS. We will quickly update you on the G20 Tax Policy Symposium. Then we'll talk about an update on tax transparency. There is some news there with the proposal to be made to the G20 finance ministers on objective criteria to possibly do a list of tax havens, of uncooperative jurisdictions. And finally, what's next on the agenda before we have another tax talks, probably à la rentrée, as we say in French, in September. Today, you will have to suffer me another time, but you also have our transfer pricing experts, Mayra Lukács, Melinda Brown, and the well-known Dr. Pros, who will brief you on latest news on CBCR and a few other topics. On BEPS, a few elements of news. The inclusive framework on BEPS. We had the first meeting of the inclusive framework for BEPS implementation in Kyoto 2 weeks ago. Happy to report to you on that. You will have a report also on the discussion drafts on transfer pricing, profit attribution, and interest deductibility, the latest on CBCR country-by-country reporting guidance, and finally the publication of Schema for exchange of tax rulings and the negotiations of the multilateral instruments. If we start with the inclusive framework for BEPS implementation, as you know, the G20 asked us to be more inclusive and to welcome all committed countries and jurisdictions to the BEPS project for monitoring, reviewing the BEPS implementation, developing further standards. We proposed to the G20 finance ministers to open up the Committee on Fiscal Affairs, the decision-making body at the OECD, and all its subsidiary bodies to these committed countries and jurisdictions, and we held the first meeting of this CFA open up to all interested and committed countries and jurisdictions in Kyoto 2 weeks ago. The good news is that many countries showed up, expressed interest, and joined the inclusive framework. As you can see from the slides, we have 84 countries today on an equal footing, which includes all the OECD countries, the accession countries, the G20 non-OECD countries, 46 countries overall, but also an additional 38 new members. And the diversity of the new members is quite striking, with small, open, competitive economies like Singapore, like Hong Kong, like Liechtenstein, and a few others, but also a number of developing countries which expressed interest in joining the inclusive framework on an equal footing. I'm thinking of many African countries, Senegal being one of them. We have Papua New Guinea, we have Bangladesh, we have Uruguay, we have all the continents which are represented. And it was quite vibrant to have these countries around the table on an equal footing to monitor the implementation of BEPS, to implement the minimum standards, and to make sure that all the countries can benefit from these changes to the international tax rules, and that all the jurisdictions are committed to leveling the playing field. We also updated the governance of the Committee on Fiscal Affairs with a steering group established. In the steering group, we have the members of the Committee of the Fiscal Affairs Bureau, which are present, but we also have other countries which joined the steering group, namely Georgia, Nigeria, Senegal, Singapore, in addition to China, India, Brazil, and South Africa. So these countries will be added to the members of the CFA Bureau, which already included a non-OECD country, namely Argentina. So we have a new governance, and the meeting was not only a ceremonial meeting, because we had good exchange of views on tax and development. We had the IMF, the World Bank, the UN present as well, with many regional tax organizations, so very concrete conversation, but also the adoption of mandates to elaborate the methodology and the terms of reference for the review of the minimum standards, as well as the approval of discussion drafts, which were released publicly. We'll come back to this, and all the countries will then further work on these drafts based on the comments we will receive. We also had another signing ceremony with now 44 signatories in total for the competent authority agreement for the country-by-country reporting. As regards the new drafts for discussion, I will turn right now to Myra, who will drive you through the changes or through the discussion draft which has been released.
Thank you, Pascal, and good afternoon, good morning. Last week on Monday, we published 3 documents. The first one is the conforming changes to Chapter 9. They were published on the OECD website, and we're inviting comments on these 3 documents. I will start with Chapter 9. It is first important to indicate that the conforming changes that are now being submitted for public comment are not new guidance. These are conforming changes that are needed as a result of the revision of the guidelines because of the work that we did on under BEPS on actions 8 to 10. Why are we needing these conforming changes? Well, as the Chapter 9 is or was before BEPS the chapter where we could find the substantial part of the guidance on risk and non-recognition. The revised Chapter 9 during the work that we did with BEPS built on the work that and the guidance that was in Chapter 9 already, but we didn't incorporate the guidance in Chapter 9 word by word. So we have needed to do work in trying to achieve internal consistency between the revised guidance resulting from BEPS and the existing Chapter 9. We also need to reflect in Chapter 9 all the updates that we have made to the other parts of the transfer pricing guidelines under the work in BEPS. We're not inviting now comments on substantive issues containing Chapter 9 or issues that were addressed under the BEPS project in relation with risk, non-recognition, or even intangibles. The type of input that we're asking from commentators at this point is to indicate whether there are still inconsistencies, either real or perceived, or there are duplications between the revised guidance resulting from BEPS and the existing Chapter 9. The comments the deadline for the comments is the 16th of August, and because there's no new guidance that has not been subject to public consultation, there will be no public consultation on these confirmed changes. Once the confirmed version of Chapter 9 is approved, it will be incorporated in the new version of the guidelines that will be publicly released in early 2017. Now, let us move to the other 2 documents that were released last week. Those are the 2 discussion drafts on transfer pricing issues. The first one is the discussion draft on attribution of profits to permanent establishment, and the second draft contains revised guidance on profit splits. As Pascal indicated, the public release of these 2 documents was actually approved at the first meeting of the Inclusive Framework in Kyoto at the end of June. And I will concentrate now on the discussion draft on attribution of profits to PEs. This work is mandated under the BEPS report on Action 7. And why are we doing this work? Why do we need additional guidance on the attribution of profits to permanent establishment? Well, we need to see how the rules on attribution of profits to PEs apply now, considering the changes that have been done to the definition of PEs, and most importantly, to take consideration of the changes that have been done to the guidance to the guidance in the transfer pricing guidelines. So while we don't think that the changes that have been made to the definition of PE deserve or really need additional guidance on the application of articles or of Article 7, we do think that the new changes to the guidelines may have an impact on the amount of profits of a non-resident enterprise that can be attributed to its PE in a host country. So what are commentators gonna find in this discussion draft? We have laid out 2 fact patterns which we think deserves some further attention and examples to illustrate how the rules apply. The first fact pattern deals with the attribution of profits to dependent agent PEs, such as commissioners or similar arrangements. And the second fact pattern involves fixed PEs, to which the exemptions under Article 5, Paragraph 4 of the OECD Model Tax Convention do not apply. What we have done in the discussion draft is build a number of examples for each of these fact patterns, and we have applied the Article 7 rules in the OECD Model Tax Convention and the authorized OECD approach. We have also made the analysis under Article 9 when it's been relevant, and we are exploring in the discussion draft what would be the interaction between both analyses under the 2 articles, and what specifically, what would be the impact of an allocation of risk under Article 9 for Article 7 purposes. In addition to this, and at the very end, the last section of the discussion draft also addresses, or more than addresses, is asking for input and ideas from commentators on which mechanisms could be developed to achieve a coordinated approach between Article 7 and Article 9. And why we do this, one of the reasons is because we acknowledge that there might be circumstances where double taxation might arise in the host country in 2 different taxpayers, the dependent agent enterprise and the dependent agent PE of the non-resident enterprise. Having said that, we're only asking in this discussion draft for comments on the application of Article 7 of the OECD Model Tax Convention. We're not asking comments on the agreed changes to the definition of permanent establishment that were agreed under BEPS. So the scope of the comments should be limited to that. And comments are, the deadline for comments will be the 5th of September, and a public consultation will be held the 11th and the 12th of October. And I will now give the floor to Melinda, who will address the discussion draft on profit splits.
Thanks, Mara. Let's turn now to the other transfer pricing discussion draft that was released last week. This one, as Mara has mentioned, is on profit splits. To take you back a little bit, many of you may remember that as part of the final report on BEPS on Actions 8 to 10, we included a scoping paper on this topic, which said that we would look to clarify the guidance on the transactional profit split method in the context of global value chains, but we weren't looking to disturb or to change the fact that the most appropriate method should always be applied. So when you read the discussion draft, it will hopefully be clear that there was no inherent bias towards either broadening or indeed narrowing the scope of the application of the profit split method. What we're looking at really is when is it the most appropriate method, and we're trying to do that by looking at a number of different approaches to splitting profits. Both of these approaches are included in the current transfer pricing guidelines, but there's not a lot of detail on how they may differ. The 2 approaches that are discussed are profit splits of actual profits and profit splits of anticipated profits. Now, the first one, profit splits of actual profits, are perhaps what we might think of as your typical or your classical profit split, where you have the actual profits, combined actual profits from a transaction or a series of transactions that are split between the parties on an economically valid basis. So it's obvious from that given that you have to do that basis of working out what profits to be split and how to split the profits without using hindsight, that the result is that both of the parties, or all of the parties if there are more than 2, will share in the impact of the economically significant risks, because those are the things, after all, which will impact on the actual profits that are achieved. So working back from that result, it seemed that it was only appropriate to be using that kind of method in a situation where the accurate delineation of the transaction indicates that both parties or all parties are actually sharing in those economically significant risks. The other approach to splitting profits was that we are looking at in this discussion draft is a split of anticipated profits. And this is a situation where we would take the anticipated or projected profits and split them by converting that split, or that share of anticipated profits, into a price or a margin or perhaps a royalty. And it's clear that in this kind of scenario, there's a much lower level of sharing of the impact of the risks. And therefore, it would also be appropriate where that matches the delineation of the transaction. So how does this fit with what we already have in the transfer pricing guidelines on profit split method? Well, of course, we have two criteria currently, or two indicators, perhaps I should say, currently, as to when profit splits are likely to be appropriate. The first being where both parties or all parties make unique and valuable contributions, and the second being where the business operations are highly integrated. So we wanted to look at how these two indicators fit with the idea of sharing of risks. And it seemed that to us that when we're looking at highly integrated business operations in particular, that where you have that very high level of parallel integration, it's almost certainly going to be the case that you will also have a significant sharing of the economically significant risks. And in that kind of situation, a transactional profit split of actual profits may well be found to be the most appropriate method. Now, while that can also be the case with unique and valuable contributions, it's possible that you may have unique and valuable contributions by both parties without a sharing of economically significant risks. But of course, by definition, if you have unique and valuable contributions on both sides, you won't be able to find reliable comparables for that transaction. And therefore, that might be a situation where it might be appropriate to have a transactional profit split of anticipated profits. So that's the main theme, I guess, of what we're looking at in this discussion draft on the transactional profit split method. I should emphasize, and I think Myra mentioned this as well, that this is a discussion draft. So what we're looking at here is not consensus guidance. What we're looking for is for your input onto the direction of this draft. We've included a number of questions in the draft, and the deadline for comments is the same as Myra mentioned before, the 5th of September for comments, and we're having a public consultation on this in October. I'll turn now very briefly to the ongoing work we have on transfer pricing on other issues. We've got a number of different projects underway, some implementation guidance on hard-to-value intangibles, follow-up work from the approach on hard-to-value intangibles that was included in the BEPS final report. We're focusing there in particular on how and when the hard-to-value intangibles approach could and should apply, and we're still considering what sort of format the guidance here should take, whether it should be perhaps policy considerations or options or something along those lines. On low value-adding intragroup services, we again follow up work from the BEPS project. We're looking to provide a forum where countries can announce what position they're going to take, whether they're intending to apply the low value-adding intragroup services approach, which is of course an elective approach, and if so, in what sort of time frame. And lastly, on transfer pricing aspects of financial transactions, we're currently looking at the scope of this work. It's potentially quite a big project, so we're looking through this year and into 2017. And at the moment, we're looking to focus on the economically relevant characteristics that would be necessary for determining arm's length conditions for financial transactions. And I think that about brings you up to date on the transfer pricing work, so I'll hand over now to Achim.
Thank you, Pascal. Thanks for switching on all the buttons so now I'm active. I can go. I'm going to talk about, I guess, 3 topics here very briefly. One is where we are on interest deductibility. The second piece is on country-by-country reporting. And then you'll probably tune out because I go technical and talk about tax rulings exchange and an XML schema. So I probably will have lost you by then. But stay tuned, at least for now. Let's start with interest deductibility. As you may have seen yesterday, we have released a discussion draft. This is the first discussion draft. It's the discussion draft that deals with the group ratio, and I'm going to explain briefly what that is. There will be a second discussion draft also under Action 4 dealing with insurance and banking very specifically. So that's going to come out soon. I think we have a slide at the end that indicates when this will be coming. So I'm going to talk about the group ratio rule. To recap, the group ratio rule is something that kicks in where the external gearing would exceed the primary rule, which is a fixed ratio rule. So to keep this practical, if you have applied the fixed ratio rule to the entity that operates in your jurisdiction, but the group as such has an external gearing that is higher than what would be allowed under the application of the fixed ratio rule, then this group ratio rule allows that the group benefits from a higher percentage if that is equivalent and to extent that it is equivalent to the external gearing that the group has. We have built some smoothing out of volatility in the operation of the fixed ratio rule, such as carry forwards for interest expense or capacity, but if there is a permanent, a structurally higher gearing, this is where this rule comes in. And of course, it also makes sure that we're not going from a situation of non-taxation to a situation of double taxation. We ensure that whatever the amount is of the actual external third-party gearing, that is something that the company will be able to deduct. So that's what it says. The group ratio allows entities to deduct interest up to the net interest EBITDA ratio of the worldwide group. There is no change to the report itself. We have already included that rule in what was agreed in the package, but we've also said we're going to work on more technical details of the implementation of that rule. So ideally also to reduce compliance costs for businesses, because if more and more countries adopt the same group ratio tax-friendly kick-out rule, then of course this will reduce the compliance cost because it does allow it allows entities then to operate the same rule in different countries, which should reduce the compliance cost when operating across borders. The pieces that I am going to highlight just very briefly, and they're not surprising, there are three elements here. There's the calculation of the net third-party interest expense. There's the calculation of the group EBITDA. These two elements make up the ratio. And then there's a particular part in the consultation document that deals with the impact of losses. So giving you just a little bit of the flavoring of some of the aspects where we're seeking your input. On the first one, the calculation, how do you calculate net third-party interest expense? And there the question is, do you take the financial statements as such, or do you make adjustments to the financial statements? The idea is that this group ratio rule can be derived from the financial statements of the company itself. So again, having in mind that we need to lower compliance costs to comply with that rule. But as we point out in the discussion draft, there's probably good reason to make a number of adjustments. The second piece is then the calculation of the group EBITDA rule. I think here, which maybe when you first read it you find slightly surprising, but when you do the numbers you will find less so, is that for purposes of determining the income here, we do include tax-exempt income for purposes of computing the ratio. While, of course, on the fixed ratio, we exclude tax-exempt income because we've always said that in order to address BEPS, we need to make sure that you cannot have a deductible expense for the generation of tax-exempt income. But then for purposes of calculating group EBITDA, we do include it, so we have the full gearing relative to the full income, which, however, then will only be applied at the entity level to the EBITDA, which takes out the tax-exempt income. So that's all explained. You will be able to go through the math on this. I just wanted to briefly highlight that point. And then the last point, the third one here, deals with the impact of losses. And that, of course, complicates the application of the group-wide rule, and so we set out some alternative approaches to balance the needs of groups and of countries. So if, for instance, the earnings drop very low because of losses, you may, if you did not have a special rule, have a ratio, a percentage that may be, colloquially speaking, out of whack. So you need to think about how you can cap that, but at the same time, you also need to protect M&Es so that you can still apply and deduct interest even where the losses take you into negative territory on a group-wide basis. All of this is set out in the document. We're very much looking to input from you on those. It is out until the 16th of August. We will then take the comments in. This is very technical. It is very important that groups engage in this discussion because it is something that is designed to help those groups with a higher gearing to make sure that they're able to claim those deductions that they actually have and do it in a way that is as much as possible consistent across different jurisdictions. So I would encourage you all to come in with particular comments on the specific questions that we ask in the consultation document. That's the first part on interest deductibility. I'm moving into the second piece. You will have seen that we have issued guidance on the application of country-by-country reporting. Action 13, you see on the slide, there's 4 particular issues on which we have issued guidance. One is what we now term the parent surrogate filing option. The second is the application of CBC reporting to investment funds, then the application of CBC reporting to partnerships, and finally the impact of currency fluctuations on the agreed 750 million filing threshold. I'm just going to very briefly talk about the first one and the last one. The first one is something that we recognized that the approach needed to be clarified to bring out that where a country, because of its legislative constraints, is not able to meet filing requirements with respect to financial year starting on or after 1/1/2016, that there may also be the possibility, and the circumstances in which this is possible is now spelled out in the guidance, where that MNE can file in its parent jurisdiction as opposed to having to file on a surrogate basis in a third jurisdiction. So that means to the extent that countries provide this opportunity, which needs to be provided by the tax administration in the parent jurisdiction, this MNE can file on a voluntary basis in this country, and then the same exchange mechanism is used for sharing this information with the treaty partners, and importantly, and everybody agrees, it then deactivates local filing in the other jurisdictions. So I think that was an important clarification that we brought to the rule, that that is a possibility. You will see in the guidance that a number of countries, they're named in the report, have already availed themselves of that possibility and spelled out that they will allow parent surrogate filing. And as we say in the report, this is a dynamic process, so we expect some other countries may also be added to that list of countries that offer the possibility of parent surrogate filing. And as I said, importantly, if it is done consistent with the conditions, it will deactivate local filing in the country of operation of the subsidiary and the branches. The last bit I also mentioned, as I said, the impact of currency fluctuations, significant currency fluctuation, if you look in the European context, we have seen very recently. So this is an important point. It basically says that if the 750 million thresholds was applied correctly at inception, there is no need to then amend it in order to go and adjust for currency fluctuations. And so if it was done rightly in the beginning, it will stay correct for the duration. We have a review clause in 2020 where we will look at the amounts, but for the period, there is no risk to go into local filing simply because there's a change in the exchange rate. And then let me be very quick on the last one. We have also issued, this relates to Action 5, a rulings schema. There is a template. This is mainly for tax administrations, less for taxpayers. It's something that tax administrations have to do. Under certain circumstances, rulings will need to be exchanged. In fact, a template with key information will need to be exchanged. And in order to increase efficiency, there's an XML schema which allows for the electronic exchange of those rulings. That is what we have now issued. It's been agreed. It's been released. And it will be used by tax administration in the exchange of Action 5 rulings. I'm going to run through the slides, but I'm not going to speak to those. Those, just as a recap, are the types and categories of rulings that are subject to the exchange discipline. Those are the countries that it needs to be exchanged with. And if you look at the process, and you can look at those slides, then this explains a bit how the process works. There's a ruling issued. It goes to the competent authority. The competent authority or the tax authority at the local level that issues the ruling, that's up to the country, completes the template is exchanged, the other country reviews it, does the assessment process, and moves into possible compliance action, risk assessment, and of course then requests the full ruling under exchange of information provision if it wants to see the complete ruling, given that the exchange is based on a template of key information. I think that's what I wanted to briefly say, and with that, I think I give it over to Pascal. Thank you.
Thank you, Arim. for this overview. Since our last webcast, what has happened on the front of the multilateral instrument? Well, we had a public consultation with some comments. People were not enthused in commenting, only 33 written comments, but easier to deal than thousands of pages received on the BEPS project. If you have further comments, feel free to send them still on time. We had a good diverse group of NGOs, business community representatives at the physical meeting, which was held last week. And the focus of the comments, unsurprisingly, was about the relationship between the MLI and the existing treaties, the question of the consistent application and interpretation, and also a big focus on the issue of arbitration and the proper way to eliminate double taxation. We'll draw on the comments to amend the text of the convention, which will be submitted for a last but one round of negotiation in September, and we expect the text of the multilateral instrument to be adopted at the latest in November, so that this text would be open for signature by the end of the year and would be signed in the first half of 2017. We're confident that this is feasible and that this will happen. We still have 96 countries part of the negotiation, maybe more, given that some countries joined the inclusive framework and expressed interest in joining the negotiation of the multilateral instrument. So far, we have more than 2,000 bilateral instruments which would be amended by this multilateral instrument. More to come, I suppose. We'll get back to this later with another webcast. A few words on what is going to happen in Chengdu. You know, Chengdu in China, and the finance ministers of the G20 will be meeting at the end of next week on Friday and Saturday, and they will have a meeting to talk about tax policy, which is co-organized by the Chinese G20 presidency and by the incoming German presidency of the G20 with the support of the OECD. And we're extremely proud and happy to participate to that important piece of work that we call the new G20 tax pillar, which will be the third pillar after the work on transparency, the work on BEPS. We now are moving towards tax policy. And we will have this tax policy symposium at a ministerial level. We have almost all G20 finance ministers registered to speak at this event, and there will be two sessions. The first session will be about how can we reconcile a tax policy which would be favorable to growth, or at least which would not harm growth, and a tax policy which would reduce inequalities, which would allow for a more inclusive growth. So the first session will be about reconciling these two approaches, because so far international organizations, starting with the OECD, have been too good at advising pro-growth tax policies, but in a way which is not necessarily consistent with the way we advise more inclusive tax policies. So we'll try to square that circle with the support of the G20 finance ministers. What the world needs is growth, is employment, and is also reducing inequalities, which is a condition to move towards more growth. And we hope that working together with the IMF, with the G20, we'll be able to come up with some innovative proposals which could be helpful to the G20. And we can keep in the back of our mind that there have been some structural changes in the environment, like exchange of information, more transparency, which may allow us to revise the way the tax policy mix has been developed so far. We have a second session which will be about certainty, tax certainty, increasing tax certainty to promote growth, to promote trade, to promote investment is a must. And I think all tax tax commissioners across the world, all tax policymakers are fully aware of the necessity to increase tax certainty. We had to rebalance the relationship between taxpayers and tax administrations by providing tax administrations with better tools to address tax avoidance, tax planning. Now that they are equipped with the better tools, they need to make sure that we have a balanced approach, that taxpayers pay the taxes where the taxes are due, but that this be done in full compliance with the rule of law. And the finance ministers of the G20 will be discussing this agenda with the idea to develop some deliverables during the German presidency of the G20 in 2017. So we're quite excited with this. We invite you to look at the outcome of this discussion, which may be reflected in the G20 communique, which will be issued after the Chengdu meeting. If we move forward instead of backward, we'll move to tax transparency, and there are two updates. One which is about listing exercise, and you will remember that the G20 finance ministers in April mandated the OECD working with the G20 countries to identify objective criteria to identify the jurisdictions which would not be compliant nor cooperative from a tax transparency perspective. The Committee on Fiscal Affairs met in Kyoto just before the meeting of the Inclusive Framework for BEPS implementation and adopted criteria which will now be presented by the Secretary General of the OECD to the G20 finance ministers. So I'll go back to the recommendation which will be included in the SG's report to the G20, and then the other part of the update is the progress made as regards the publication of the CRS status message XML schema that Arim will decipher. I must say that when reading this title, I could be lost, and I'm sure that Arim will show us the way later on. Quickly, or not, on the objective criteria. In order for a jurisdiction to be considered as cooperative from a tax transparency perspective, what are the elements which are objective and which are available? The first one is about the way a jurisdiction implements exchange of information on request as assessed by the Global Forum on Transparency and Exchange of Information for Tax Purposes. And we have an objective criteria here with objective assessments which are consensual by the Global Forum. We have ratings there from non-compliant to fully compliant, with partially compliant and largely compliant, and it seems that being largely compliant is something important to be considered as doing fine. The second objective criteria is about the commitment to do automatic exchange of information. You know that countries were invited after we developed the standard for automatic exchange of information to commit, and now all the countries and jurisdictions have committed to automatic exchange of information starting in 2017 or 2018. And the commitment is extremely important in terms of showing that a jurisdiction is getting fully transparent, and we'll of course monitor this commitment and the way it's implemented, but for the time being the criterion is about the commitment. Third is about the legal instruments. If you commit to doing something, you need to have the legal instrument to be able to implement your commitment. And we have one instrument which is now signed by almost 100 countries, or is covering 100 countries and jurisdictions, which is the Multilateral Convention on Mutual Assistance. And signing this multilateral convention is a good sign. And if you have not signed, because you cannot, like some jurisdictions, but if you have then a treaty network which is fully compliant and is able to cover automatic exchange of information as well, then you would be fine. Now, what is recommended to the G20 finance ministers is to say if you don't meet two of these three criteria, then you have a problem. Basically, if you're partially compliant and if you have not signed the Multilateral Convention on Mutual Assistance, you could be considered as not doing fine. But there is another another dimension, which is if you're non-compliant or if you're assessed non-compliant by the Global Forum, or if you don't move to the phase 2, meaning that your legal framework is so insufficient that it's not even worth checking how you do in practice, then you will be considered as non-cooperative. And this proposal is going to be made to the G20 finance ministers, who will decide on the way forward. What the Committee on Fiscal Affairs and the G20 countries decided to propose to the G20 to do is to adopt these criteria, but not to do the list before July 2017, which will be the date of the summit under the German presidency, so that countries and jurisdictions which will be able to identify themselves based on the criteria, would have time to change their legislation, change their practices, so that they would not be listed in July 2017. Now it belongs to the G20 to decide what to do with this recommendation. We have to highlight the fact that are in the scope of this exercise only the countries and jurisdictions which are also financial centers. In other words, developing countries which decided to join the Global Forum to benefit from the new transparent environment, but which were not asked to commit to automatic exchange of information, are not part of this exercise and therefore not likely to be listed. It would not be relevant to list countries which are not financial centers and therefore are not a threat to leveling the playing field or a threat to the revenue, the tax revenue of other countries. This will be presented, and I invite you to check what will be in the communiqué of the finance ministers in Chengdu. On transparency, Arim will brief you on the other aspect of the progress made recently.
So then let me take you from the exciting policy front office to the perhaps less exciting back office, nevertheless very important. As the Secretary General, I guess, says, we're not a think tank, we're a do tank, and this is in the segment of the do tank where we do things, where we do worry tremendously about the implementation of the policies that we have developed. So what does that mean if you step back without the details? And this is something that's not just for tax administration, it's also important for financial institutions and the advisors of financial institutions, because this will affect financial institutions in the implementation of the CRS. We are in the process, as we have indicated earlier, of developing a common transmission system which will connect tax administrations around the globe for secure, encrypted transmission of information that will travel between those tax administrations consistent with the standard that we have developed, and where you exchange CRS information that, as you will recall, will come from the financial institution. It will be reported to the country of residence, and the country of residence will then exchange this with the country of residence of the account holder. This is bulk transfer, so this will go on the basis of a schema that we've developed through a secure transmission system which we are developing and traveling there. Then when the tax administration downloads it, it will have to look at the message. Now, there may be instances where this message is deficient, and given that this is a global system that connects thousands of financial institutions with a large number of countries, this needs to be a standardized process where you find that the data is incorrect. It may be incorrect because of the file itself or the records inside the message. So what we've now developed is a system of feedback where the tax administration that receives the information detects that there is something incorrect in the message. It can send that back to the country that has sent it, and then most likely the sending country will send that back to the financial institution that has originally provided the information. And in order to standardize the process, because this is bulk data, this is significant volumes, we have, for instance, standardized over 60 error codes, so you can link the error code to the file. You can easily detect which one the file was and what the problem with the file was, so you can rectify it. And then there's a tracking system that then also allows you to show which one is not a corrected file, so you can send it and push it back through the system. So we end up with consistent information and a relatively easy process of correction, so that the information is sent, is actually used. Importantly also, we have worked extremely closely with our friends in the United States, so this is very consistent with what is done for FATCA, but at the same time we've picked on the aspects that were developed in the EU. So if you are a country or financial institution, there is the same things being done through this process. So we're keeping the system together, we're standardizing it, and hopefully making it much easier for everybody to operate. Thank you.
What's next? Well, we have a busy summer ahead of us, in spite of being located in France. We have the G20 Finance Ministers meeting that I mentioned earlier in Chengdu next week, at the end of next week. And we'll have the G20 summit early September in Hangzhou in China. And then, by then, we'll have some public consultations. You can see them on the slide. At the end of July, we'll have a discussion draft on interest deductions in the banking and insurance sectors. The first week of August, discussion draft on branch mismatch arrangements, and mid-October, we'll have a public consultation on the attribution of profits to permanent establishment and the revised guidance on profit splits. We'll try to update you on where we are, probably in September. The date is to be fixed, but I would say mid-September or late September to have another tax talks. If you liked this one and if this is useful, your feedback on the webcast would be really appreciated. We now have time to take a few questions. I would like to start with the first one. Quite basic, but I understand it. You have some transfer pricing geeks. They have their own language, and sometimes when you join the club or the group, you may feel lost. So one of the questions is whether the panel knew of any good further resources to learn about transfer pricing and the best way to go about it. So if you want to know about transfer pricing and never dared ask the question, Myra, what would you consult?
We haven't yet issued a dictionary, so you can understand our language. But I don't think it will come to a surprise to our audience that I think probably the first place you could look at is the OECD website. In our website, we have obviously our transfer pricing guidelines, the BEPS reports. We have created some very didactic materials when we started doing this webcast on how these rules apply. But especially there in the website, you can find a number of discussion drafts and comments that we have received from stakeholders, which might allow you to understand a little bit better why we have the rules that we have. If you look at resources outside the OECD, the UN has put out a transfer pricing manual, which is also explains in a pretty understandable manner how the basic transfer pricing rules apply, and also contains an overview of how certain countries apply their transfer pricing systems. And then obviously there are a lot of websites which will allow you to access very interesting articles from academia, which provide food for thought, and I think that would keep busy the person who asked this question for the rest of the summer and beyond.
Thank you, Myra. The second question is still related to transfer pricing and is about the complexity of transfer pricing rules and what to do with developing countries as regards the complexity of transfer pricing rules. Melinda.
Thanks, Pascal. Also a very interesting question. I find it curious when people say transfer pricing rules are complex, because the implementation, of course, is complex, but the arm's length principle is something we all have experience with every day, and it's actually relatively simple. I probably get caned for saying that, but in terms of implementing those rules, yes, it can be complex. And for developing countries to get a handle on those, well, we run a number of programs here at the OECD to assist developing countries as part of our tax and development program, as part of our global relations program. We also have a number of toolkits that we are developing to assist developing countries in implementing some of the BEPS measures on transfer pricing, on comparability, for example, on transfer pricing documentation. And I think importantly for developing countries that become involved or that are involved in the inclusive framework, we will be providing support to them from the OECD and from the other international organizations that we work with, so that they can really participate on an equal footing, so that they can really have a voice at the table in an effective way. And we're exploring a number of ways of going about that, including providing particular support to those newly joined countries, so that they can fully understand the issues that may have been discussed at a number of meetings before they attended, and can bring their own unique perspective and their input on those questions.
Thank you, Melinda. A question for Arim, which I understand will be about beneficial ownership and other type of FATF question. Do you think due diligence and know your customer requirements should be detailed more, or some other requirements should be introduced? Arim.
Yes, Pascal, I think that's a very broad question, not something that we've specifically covered in this webcast, but something quite active. You recall, just to give context, that the G20 has given a mandate in the space on beneficial ownership information on the implementation of the existing standard, both to the Global Forum on Transparency and also to the FATF. The Global Forum, in its terms of reference, has now included beneficial ownership, and of course the FATF is also having a hard look on beneficial ownership in this space. It's certainly fair to say that a key issue here moving forward is to make sure not necessarily to impose additional requirements or new standards, but the implementation of the standard as it is. That is challenging. The FATF standard, which is identically incorporated in the terms of reference on the Global Forum, does look to the warm body at the end. There may be a chain of entities. So the implementation of that standard is certainly a key piece of work. I think it is fair to say that if you talk to the tax people that are talking to you right now, then of course, in the CRS and the common reporting standards, we have built on money laundering rules. We have added certain elements such as tax residence, which is relevant for tax people, but not necessarily relevant for the AML people. So there are some questions as to whether from a tax perspective there is something. We've certainly done that in the CRS. You also see in the European space, but also more other, that there is a convergence and an interest of, if you wish, a more holistic approach where it's a multi-agency approach to fighting financial crimes. So that's in the tax crime space, but also in the money laundering space. There's an interest in suspicious transaction reports. There's interest in the information that may be held by tax administration. So I think it's quite an active debate. I think important is to recap, I think, to make sure that the existing standards are implemented, and then gradually with a mapping type approach, one can work towards perhaps seeing whether there's a need for something else. And take it through the staged approach, which may or may not, without jumping to conclusions, then also result in some potential additional requirements that may come in over time.
Thank you, Arim. I'll take the next question, which is about whether countries and jurisdictions which have joined the inclusive framework will be reviewed against their compliance with the minimum standards and the BEPS package. And the answer is yes. If you commit to implementing BEPS, in particular the 4 minimum standards, which are 1, Action 5 on harmful tax practices, 2, Action 6 related to fighting treaty abuse and treaty shopping, then the country-by-country reporting, and finally the mutual agreement procedures improvement, yes, you will be reviewed in your implementation of these 4 minimum standards. The inclusive framework in Kyoto adopted mandates to the different working parties, which will be in charge of the review, for the working parties to elaborate methodologies and terms of reference to organize the peer reviews. And there are a number of questions which will rise. What kind of peer reviews do you carry out? Is it a peer review similar to the Global Forum, which is pretty heavy with independent assessors, a peer review group, or can it be simple? Actually, it depends on the cases. Harmful tax practices, we do have a framework. We do have the Forum on Harmful Tax Practices. We do have methods, but we also need to revise them so that the timeline for implementation for the newcomers must be adapted. We cannot ask them to do automatic exchange of tax rulings now because they're just joining the inclusive framework. So this will be developed in an inclusive manner with all the newcomers on an equal footing by year-end, so that at the next meeting of the inclusive framework, the next meeting of the CFA at the end of January 2017, the draft mandates will be submitted to the Committee on Fiscal Affairs, and then the reviews will start, or they may even start earlier than that. That's the case for harmful tax practices, and the countries will be assessed. Of course, there will be, and that's another question, another issue, there will be a difference of treatment between the developing countries, which want to join to benefit, but which are not a threat to leveling the playing field, and other economies which are more competitive and for which it's very important that we get full implementation as early as possible. approval. And it's the group itself which will decide on the different timelines for the different types of jurisdictions. So yes, there will be a peer review, but this will be adapted, this will be soft, smooth, but efficient as we need countries to implement the BEPS package. The second question I would like to take is about why some countries have not joined the inclusive framework yet. I would add yet, even though it's not in the question. And the person who sent the question asked about Peru and Kenya in particular. Well, Kenya, if you look at our website, you will find Kenya on the list of countries which have committed and which have joined on an equal footing. So the answer is quite simple. Kenya has committed. As regards Peru, Peru was involved in the work on BEPS when we developed the work, not on equal footing, and we expect Peru to join soon. I think the main reason why Peru has not yet committed is that the time where they had to commit was an electoral time in Peru with the presidential election and parliamentary elections. Peru was present in Kyoto, and we are very confident that they will join. Then for developing countries, it's up to them to decide whether they will join or not. They are more than welcome if they want to shape the agenda, if they want to participate to the work that we've just mentioned on transfer pricing, simplifying the rules, adapting the rules to their specificities, discussing about profit split, monitoring the implementation of the BEPS package, making sure that they benefit from country-by-country reporting. There are a number of benefits for them, but it's really for them to join. We don't want to push them, but we will be welcoming them. There is another category of countries and jurisdictions which are what we call the countries and jurisdictions of relevance, meaning that if they don't join, this may be a threat to leveling the playing field. And these countries and jurisdictions may be identified by the different groups which will be in charge of the reviews, so that if they have not joined the inclusive framework, they will be invited nicely to join the inclusive framework. And if, in spite of a nice invitation, they refuse to join the inclusive framework and to commit to implementing the BEPS package, they will be reviewed, and their compliance with the BEPS minimum standards will be made public, with them participating to the review. But if they decided not to join, too bad for them. So this is to be monitored with more than 80 countries on an equal footing, with another 20 countries which had participated in Kyoto without committing yet to the BEPS package, without joining yet. We expect to have almost 100 countries by year end to be part of the inclusive framework, which is pretty important. We will take a last question that Arim will take, and then we'll close the webcast. Arim.
Yes, I will read the question and I'll give it to somebody who's not expecting it, so we make it exciting to the end. No, I will try to answer it myself. I think it's a good question. The question is this, I'll read it. When will the OECD make available the exchange relationships, i.e. the list of jurisdictions, the competent authorities with respect to which it intends to have the MCA in effect under the CRS and country-by-country reporting?
Translate the question.
Translate the question first. I will do that. Thank you, Pascal. Into French. No, I will stay in English. The competent authority agreement, the multilateral competent authority agreement, in fact, as it says, is a multilateral agreement. It has been signed by now over 80 countries and jurisdictions that are covered, but it is a framework agreement. It is the basis. It sits on the multilateral convention, in fact, on Article 6 of the multilateral convention, and it creates the framework within which the exchanges on CRS, on financial accounts, will take place. But it is only activated subsequent to the filing of a notification. And one notification, and we have sometimes loosely compared this with speed dating, also means that we need to have matching pairs. Now, we're receiving these notifications, and the bilateral exchange relationship is activated when we receive two matching notifications. When we receive those, we will be making those available. In fact, we will be making those available publicly on our website in September. So in September, we will go live with the CRS notification. This will be, and this is important, this is a dynamic process. The first exchanges are scheduled for September of 2017, so that will be a year away when we start publishing. And of course, that's the first wave, and there's a second wave where those countries come online that will go in 2018. So we will start the process. It's the beginning of process. We will be publishing those countries that have actually now created and activate a bilateral exchange relationship, because the information will be exchanged bilaterally. But importantly, this will be a beginning, and we will continue to update it over the period leading to the September of the exchanges in 2017, and then also September 2018 for the second wave of exchanges. Thank you.
Thank you, Arim. It's time to stop these tax talks. We were very excited to bring these news to you. We hope that you enjoyed the webcast. Again, your feedback would be welcome. We hope that we didn't have technical problems today. And we look forward to talking to you again after the summer break, which will be short on our end, probably in September. We will post a date soon on our website. If you have further questions, do not hesitate to post them. We'll be happy to respond to you. And please have a look at the outcome of the G20 Finance Ministers meeting next week in Chengdu, with some exciting parts like this new tax pillar on tax policy. Thank you very much for your patience and for being with us today. And we wish you a good summer if you have the opportunity to have some break. Thank you very much.